All right. Hey, good morning. Sorry for I'm running a little bit late. For some reason, my go-to meeting is acting funny here this morning, and it's telling me I've got network connectivity issues. Maybe that's tied to the weather we had here overnight. So if I'm not coming through clearly or can't hear me, just send a message or unmute yourself and chime right in. Um, all right, so I'm going to jump right in, and I think we'll start with a uh, with a fundamental quick overview on kind of just what are the big picture items that are going on. And the biggest thing that's happening right now is South American harvest and weather, right? So they're harvesting in Brazil, and they're trying to plant their second corn crop or their safrinha crop. And then second is in Argentina, they're trying to pollinate a crop and get that crop to market. So in the South, it's dry and they've been fighting flood issues. In the North, it's been too wet and they're fighting flood. So South drought, North flood, and so why aren't prices just moving, right? How come we're not moving? Uh, how come we're just kind of stagnating? And if you've been like me, it feels like the market is down almost every single day. And it just feels like we should be lower. And then you look at the market and we're still holding much higher levels. So why is that? What's going on, right? If we have a wall of supply coming from South America, then why aren't we breaking this thing? And the reason is because we need it, right? We're not short, or we're not oversupplied. We need every single bushel that we can possibly get. And so no matter what the weather does or the news is, the market just keeps getting bought on every kind of a break. And so what's going to change that? What's gonna move the needle and cause these markets to really break and do what everybody's afraid of doing, which is, we're gonna rip $1 off of corn and we're gonna go back to 350 new crop corn and life's gonna suck again, right? That seems to be kind of the feel and the feeling of what's going to happen. Well, I'm definitely not in that camp in any way, and I don't see anything on these charts that would tell us that we should be expecting that to happen. So, let's take a look at what's going on and build a couple more fundamentals into this as we get going. Here's May corn. We've been looking at this chart. We traced this wedge from the kind of the early part of February all the way until earlier this week. We had a false break to the bottom, a false break to the top, a false break to the bottom again, and now I think this one's going to hold up to the top. As we break this high right here of 56.25, which we did in the overnight session, as that breaks and we keep moving, that should trigger buying, and we should then come at least challenge this high. And really, I think the target's 591 to 615, somewhere in this range right in here. And I think that'll happen relatively quick as it goes. But then I don't think we're quite done from there, because we've got a long way to go before we have enough supply in this country in order to oversupply this market. So I think we come to this area, and then I think we probably trade back down and maybe even test this 550 level again, and then push higher up into the summer. If a couple of bullish cards fall or get turned over in the bulls' favor, I think that the 2012 highs are at risk at some point in the next 12 to 15 months, because we're just too short of corn. There's a Bloomberg article out yesterday where some of the Chinese analysts are talking about China importing 40 million metric tons of corn next year, as opposed to the 20 that they did this year. So just stop and think about that for a second. They might import double what they did a year ago. Their supply issue is not finished, it's not done, and they still need more acreage and they need more product because their demand is that strong. Because remember what's happening over there too is their economy is in good shape and they are feeding their people better than they've ever been able to feed. So they've got a population that's what 4 times our population, and here in the U.S., we're all spoiled, right? Even the poorest people here live better than most people all over the rest of the world, and we take for granted that just how blessed we are. And in China, they still have a huge portion of their population that lives in extreme poverty and has never had a steak. And so as that minority shrinks, and more people quote climb the protein chain, that increases demand. And so that's what's really underpinning this market is China's people coming out of the third world status and more into the domestic status. Oh, come on, Tim. That nobody lives like that in China. They do. It's a huge country. There's billions of them, and they do not all get to go order filet mignon every time they go out to eat. It's a very different culture, and so that's why they're expanding their hog herd. That's why hogs are going nuts. That's why cattle demand is strong. That's why this market just keeps getting bought, and you can't break it. So technically, we're looking good. I don't see anything here that gives me any pause whatsoever. New crop corn is been the weakest this week, but all that we're doing here in this market is redirecting the spreads. So this is a spread chart between July and December. Okay, so this is just taking July minus December and putting it on a chart, and we've rallied this spread 25 cents this week. So that puts bullishness into the front month and holds the back month down a little bit, as these guys bull spread it. And that's really bullish for flat prices, right? You have to rally the basis, then you rally the spreads, then you rally the flat price. And basis has been increasing along the rivers. Our spreads have been going crazy, and flat price should follow soon as we break up out of these wedges. And so I would expect this to find support and move to new highs relatively soon. I think 5 is a no-brainer for it to challenge, probably higher. From a hedging standpoint, we've got the big quarterly stocks and planting intentions report coming up in a few days, and there's lots of questions about what do we do. Do we need to be hedging? Do we need to be taking action? Well, let me make this really simple. You guys have a put right here at this price level. Sorry, I need to take this off and move to here. You guys have a put right here at this price level. Boom. So you're protected on 80% of your production below that level right there. Now, that's crop insurance, but that's where we're at. We're only trading 25 to 30 cents above crop insurance levels in this market. So I think that the need to hedge and hedge aggressively and defend downside with puts or cash sales, I'm not buying it, and I don't think we should bite on that because I think that our protection is just fine. So let's talk stocks to use for a minute here and talk about where corn could trade if our stocks to use goes up or down, right? We talk about the carry out. We're currently projected at 1.5 billion, and that's equating out to about a 10% stocks to use. Well, a 10% stocks to use ratio is above 450. A stocks to use ratio that starts to climb above 12 to 15% puts us back down into this neighborhood of 420 to 380. And so you got to take a step back and think about what the situation is, right? You've got demand that's off the charts. You've got all of the products going crazy, including ethanol. It's on the rebound, and this country is on fire. I mean, we're just going crazy everywhere you look. And then you've got the government printing trillions upon trillions of dollars on repeat, just throwing money at people. And then those people don't need it because nobody lost their job. And so now they're just going to spend it. And so that's just gonna circulate through the economy. You know, this last stupid COVID relief package that we just did. You know, if you have a 5-time multiple on a dollar circulated, that is that's a $25 trillion capital injection into this economy. So we're just going to go crazy with everything that we have going, and that's not bearish for commodity prices, not just because of inflation, but because of just demand. So our stocks to use ratio, just think about it. Is our stocks to use, are we going to plant so many acres in the US that we're going to drive that stocks to use ratio all the way back to 15 to 20% this year to push prices back down into here? I think that's an extreme long shot. And now maybe come July, if we do plant 95 million acres and they yield 185 and demand falls off because we have a new pandemic, you know, okay, now we're talking a different story. But today, you got to weigh the risk in exchange for the reward. What are we going to do? Go out and spend 50 cents a bushel to double up on crop insurance from 450 to what, 425? Like, our risk is not that significant. I mean, if this market breaks from in March, April, and May down to 425, and beans don't break, this will be the buying opportunity of a lifetime down in here, honestly, because the price of corn could double if China keeps buying and we just grow normal crops. So the fundamentals do not support lower prices at this moment. You know, we're gonna do a lot of what if scenarios on the planting intentions report. Everybody's terrified that we're going to plant 95 million acres and that we're just going to immediately crash it and sell off. And we might, but that's where we should buy it. That's not where we should be scared of it. And I don't think hedging it is the right play today. Now, if we're up here at 520 next week, I have a different opinion on that, because now we've got a dollar spread between our crop insurance level and where we're priced. So, but at 475 against 454, I'm not crazy about that idea at all yet. So, and it's Wednesday, so you know we can change our mind between now and the 31st. We might change it 2 or 3 times. But look at this weekly chart, right? We broke it last week. We tested the 9-week, and boom, piercing pattern. This begs for higher prices, at least 3 to 5 more weeks of up. We've been consolidating at this 550 level, trying to get up into this significant level right in here. And let me back this up. You know, this right here is huge support for us. That's at 520. So your old crop risk is like 30 cents and your new crop risk is 25 cents. I think the best way to trade this is just to hold where you're at coming into this report on corn. All right, now let's look at beans. Same thing with beans. We finally broke up out of this wedge. You know, they're harvesting, and if you look at the shipping, the maps where they show all the boats floating around, you know, there's dozens of boats going from Brazil to China, and the market should be under more pressure than it is because China is buying from Brazil. But that doesn't mean that they're not buying from us. That doesn't mean that they're going to cancel our shipments and move forward. That means that the market's just doing what it's supposed to be doing, and things are going according to the plan. It's not bearish, and that's why this market's not breaking. So African swine fever. Okay, so there's a new strain of that breaking out, and China is you can read conflicting reports. For the most part, the reports are saying they have it under control, and really they're just continuing to consolidate that hog herd into larger state-owned production facilities rather than having tens of thousands of small farmers doing it. So that demand's not going anywhere. If anything, that's more bullish for our hog market. And until something changes, I don't think that we're going to end up breaking soybeans a whole lot coming into this report. If beans can break this 1434 level in May, then I would definitely look up to this 1516, 1550 area. Still, I see nothing here that shows weakness. And if we start to break this low right here at 1392, which is this low, then that'll give us some pause of concern, right? Now we're below our trend line. We've broken some significant lows, and maybe we'll have a deeper break if that falls. But right now, I just don't see it. So new crop beans, right? What about those? The planting intentions report. Guys, we need to plant 7 million extra acres of beans just to hold serve and not go negative. I don't know how that's bearish. Yes, 1240 corn or beans look pretty good on paper, but not as good as 16. And if we end up dry at all, or South America gets into any sort of trouble, or China keeps buying, we haven't rationed yet, and I don't think that that's gonna stop. There's some reports out that say, well, our crush numbers for the month of February weren't very good. Well, that's because we froze to death. We spent half the month of February in the coldest cold snap that we've had in years, and they couldn't keep their plants running. It's not because we lost demand. So all of that's going to come back too, and we're just going to keep putting pressure on these markets until we slow it down, because the market shouldn't let the pipeline turn negative. So on this chart, all systems go. Look at the weekly chart. It's the same thing. Just tremendous strength. Yes, we'll get a deeper pullback at some point, but for the next year, or until we plant and pollinate just a huge wall of supply that is like a tidal wave, we've got to be looking to the upside on these markets, not the downside. And I don't see anything that's shifted that. So this is the last chart I'm going to show, because this one's kind of weird. I think this is really bullish corn. So this is the Kansas City wheat corn spread. And for those of you that aren't from this area, that's an important spread, because in Southwest Kansas and in the panhandles of Texas and Oklahoma, where all the cattle are, when wheat gets too cheap, we start to feed it, and they put it into the food ration. Well, wheat's cheaper than corn, so why is that? Well, it's because we have plenty of wheat, and we're rationing corn. We're actually trying to slow down the grind of corn and the consumption of it. But here's the problem, is that if we feed too much wheat, that's incredibly bullish wheat, because we're not that tight on wheat, and we still have a growing season to go. So wheat's come off a little bit, but it's just increasing its own demand story. So I look for wheat to move back up into this 450 range pretty quickly, before we end up kind of taking a pause and seeing what corn does. If corn takes off and rallies, wheat's not going to just implode. If beans take off and rally, corn's not going to implode, which is bullish for beans. So I think wheat's pretty safe here. I don't want to see it come back down and start closing below 595, but I think it's worth letting corn do the work for wheat here in the short term. So we got a long way to go before we bring this wheat crop in. It looks really good today after Sunday's and yesterday's sunshine. Everything looks nice and green, and it's going. We've got some moisture. That's good. We need it just to maintain where we're at because of the corn situation. All right, that's where we're at. We'll have more videos coming out on supply and demand and more hedging thoughts if as they come in. You know, if you want to be hedged, then by all means be hedged. I'm not trying to talk anybody out of it. For the bushels I'm managing, I'm comfortable with where we're at because the totality of everything dictates that our downside risk is not extreme at the moment. And so I don't think it warrants a huge outlay of capital for hedging. Remember, there is significant risk in trading futures and options, and you should be aware of those risks and make decisions that are within your financial wherewithal to be supportive. And these markets are volatile, and you can lose money doing it. I hope you guys have a great day. We will talk to you next week.